morning, good afternoon, everyone. This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On today's call, we've got several members of the team that I think you all know well at this point, but starting over from his perch in Madrid, we've got Patricio Alvarez, Senior Gas and Utilities Analyst, looking after that part of the energy complex in Europe. Coming across the pond, we've got Vince Piazza dialing in from Wilmington today. He's our Senior Oil and Gas Analyst covering Exxon, Chevron, and so on. And then over to Scott Levine at our New York City headquarters, 731 Lexington, who covers many things for us, including some of the energy service and drilling names. So I think we'll do a quick kickoff with how the earnings cycle is going. For anyone who's unaware, we've had a number of the big energy names report out already. We've still got more to come, but Vince, we're going to come to you first because I know Exxon and Chevron have just reported out. So tell us what we heard and how you're thinking about those names after getting the 1Q results.
Yeah, it was very interesting. So, Exxon was really weak off the earnings, despite the pre-announcement. I think the market was really focused around the refining results, the timing effects, maintenance, and so forth. So a lot of moving pieces, but we were laser focused on the $10 billion of free cash flow generated in Q1, and that was more than sufficient to cover the divvies and also the buybacks, which totaled around $7 billion. The balance sheet is really healthy. Over $33 billion of cash on the balance sheet. Net debt to cap roughly 3%. So we were pretty excited about, despite the timing issues, we were pretty excited about the quarter, and we didn't hear anything about the Pioneer deal that would lead us to believe that decision would be extended too far post the expected closing date. Chevron, the shares did better than Exxon, but I had looked at the underlying numbers, and I saw free cash flow below $3 billion. I saw distributions somewhere around the $6 billion range. Net debt to cap wasn't as impressive as Exxon's, and you also have the overhang of the arbitration with Hess and Exxon over Guyana. So a lot more questions there, but overall I thought Exxon's results were very strong. Chevron talked about getting to their production target for the Permian at the end of 2024. It's somewhere around 900,000 barrels a day, and that seems to be on target. So lots to like about both. I have to give Exxon a little bit of the upper hand, the edge here, just given what they reported on free cash flow and that bulletproof balance sheet. So I felt pretty good coming out of those Friday earnings. In general, Rob, we talked about this from time to time. I'm looking here, and this morning nat gas is trading below $2. I still think that's unsustainable. We can get in more on that later on, but I think that's where a lot of folks are. That's where a lot of folks are thinking about at this point. What happens with nat gas as we go into the shoulder season and head into the summer cooling season.
Okay, thanks, Vince. Let's swing over to you, Scott. I know you had Transocean report yesterday. When you look at the service names, is it a similar good news story or something a little different?
I think it's a little different. Starting with rig was down over 10% yesterday. And it was a similar story to what we've seen the last couple of quarters from them. I think, the offshore drillers did very well last year, And then toward the end of last year, their concerns grew that we were starting to see an air pocket or a slowdown in contract awards. And so what we saw at Transocean, which is really the first major offshore driller report, is that continues. They took the guidance down for the year a little bit, not just bookings. The backdrop still remains healthy, but backlog edged a little bit lower, and we're seeing delays in terms of the contract startups. And that's what's driving the numbers down. So they beat the quarter, but they guided down for the year. They echoed the recent commentary that this recent slowdown in floater awards is really more a function of timing than anything else. We're still seeing an elongation of the contract terms. It's just taking a little bit longer to strike contracts, and folks are striking them further in advance. So from an offshore perspective, we have Noble and Valaris reporting. Valaris tomorrow, and then Noble next Tuesday. And we'll see if they're saying similar things. But by and large, the fundamental backdrop remains healthy, but the near-term earnings story not as rosy as investors were hoping for.
Okay, thanks for that, Scott. Patricio, let's swing around to you. I know you've had Fordham, Iberdrola report. Tell us what you heard there. Frame it relative to what Scott and Vince just told us. What kind of 1Q did some of the names that have already gone have for you?
So, I think the main difference is that these companies have a higher share of contracted earnings, so tend to be more stable. But overall, in that context, both companies reported better than expected results through both operationally and also on the net income level. And on Iberdrola's case, that came with a special income or a special gain from a disposal in Mexico. But we do highlight that underlying earnings growth is still very strong, and it's because the company has been pivoting to a higher spend in U.S. Electricity grids and also UK transmission grids, and that's sort of where the sector is shifting towards, given that renewable power generation has become a bit more challenging. Investments there have been dialed down once again for the next 3 years, with almost 70% of the budget going to grids, which is something that is worth highlighting. And then on the other front, you have Fortum, which is an independent power producer in Finland, which means that it has to compete with very low prices and very high hydroelectricity volumes there. And still, the company also beat expectations, meaning that the company was able to optimize storage better than most people expected. And that, I think, shines a bit of light on the sector in general, because the whole index, the European Utilities Index, has been very much punished on a valuation standpoint, both by higher for longer rates and also because of this rapid decline in both gas and power prices in Europe. And I think this 1Q is shedding a bit of light on utilities' ability to sort of offset these rapid declines in power prices. And it should have supportive read across, I think, through the end of the year.
Patricio, I want to follow up on that last idea you were just talking about, because in the U.S., we have seen retail rates for power really headed higher. To set aside what's going on in the wholesale power markets, consumers have been paying more. I think this has been inflationary. And in some places like California, you're paying 2x the national average or even a little more. California is approaching like the German price level, at least of what the retail residential consumers pay. So it is that idea that you just talked about, where power prices pulling back, is that just the wholesale power market, or are consumers seeing that as well?
So yeah, that's an interesting question, but So in Europe, you always have two markets in most jurisdictions. When you talk about the regulated market, which tends to be tariffs that are pegged to wholesale electricity prices. So that's like the UK's standard variable tariff, which gets updated every 6 months to reflect the changes in wholesale power prices. So people who are exposed to that tariff, they are already seeing power prices and gas prices come down on their bills. So that is roughly, I'd say somewhere between 35 to 40% on average of customers are pegged to the wholesale power market. And then the rest of them, the 60-ish%, are pegged to bilateral contracts. And these are the contracts where utilities tend to make their profit on. These companies during the energy crisis saw wholesale rates push up very high to extreme levels, which incentivized customers to pivot from the wholesale market to these bilateral contracts, which are usually 2 to 3 years long. So that's why integrated utilities in Europe are still doing okay, because they managed to hedge prices at higher levels, and the energy sourcing costs, which are usually wholesale power and gas costs, those have come down quite abruptly. So they're still enjoying, I'd say, a good year and a half or so of decent margins. But after that, yeah, I think eventually tariffs for those customers will have to come down. It just takes a bit longer.
Okay, very interesting. So one of the things that is very prescient in power markets is what's going on in the gas market. So gas often is the marginal electron in both Europe and the US. So I think let's bring Vince back on. Vince, we've got US gas, Henry Hub, sub $2, European gas, over $9 per MMBTU. No, it's not priced in dollars, but give us a sense as we look into the summer here. What's your view on the U.S. gas market? Are we going to stay sub $2? And what's your view on kind of the demand picture looking like at that price point?
Yeah, thanks, Rob. We've been talking about this for a while. The winter was really, really difficult. We've had a warm winter. We had storage over the year really build out. And now we're sitting here in the U.S., 2.4 TCF in the ground. That's 37% above the 5-year norm. So we are well supplied. If you look at European storage, Patricio will tell you it's well supplied as well. So, the impact that we made in sending spot cargoes in light of Russia-Ukraine conflict, that really helped to build out European storage. Here in the U.S., we're heading into a lull in demand. That's the shoulder season between winter and summer. The good news here is that gas volumes have come off. We were averaging somewhere around 102 BCF a day during the wintertime. And now we're well below 100 billion. So the capacity that the E&Ps have taken off because of low prices, that's actually working. April closed flat with last April. So we're under 100 BCF a day. The operators are doing what they need to do to help balance the market. You're just not seeing it on the demand side. Power gen is roughly 2 BCF a day below where it was last year. LNG feed gas is another 2.1 BCF below where it was last year. You've had maintenance, you had capacity come offline because, quite frankly, Europe doesn't need the molecules right now. They're pretty well stored. The economics suggest flows out to Asia are more profitable than flows into Europe. So the market right now will likely remain loose. Balances are loose. We still have an oversupply situation because of where we are on storage, and we really do need to get a little bit of a heat wave going. We have some heat this week on the East Coast, but for the most part, we need the summertime to kick in. The summer is not as demand heavy as the winter, but it does help dilute the injections. But we could be looking at a pretty robust storage picture even through the prime or peak summer demand side.
Patricio, let's swing back over to you. Tell us how Europe looks for the summer. I get the sense that we've got a similar oversupply situation perhaps in Europe. And if that's the case, try to explain that big disconnect between Henry Hub and TTF, if you don't mind.
Yeah, sure. I think the big disconnect in prices is just because we are a net importer of gas. We are not able to be self-sufficient on the production front, and we have to compete with spot cargo with Asia throughout the year. So that's an interesting point to start, I think. By now, considering that demand in Europe has come down almost 20% since 2021 and has remained at those levels since the end of 2023. On that basis, now LNG has fully replaced Russia's share of supply here in Europe. LNG roughly represents 40% of demand here in Europe. But that said, demand levels are still very low, still very anemic at minus 18 to 20% below the norm, both because of mild weather and also because let's say the rebound in industrial activity has been very weak. So far, industrial demand has picked up by low single digits year over year from a very low base in 2023. So the prospects of underlying demand are still very weak, I'd say. Well, that's obviously mentioning the fact that Europe is kind of coming out of a mild recession in late last year. So things may look better on the second half, but still, I think the overarching story is still storage. We built a significant storage buffer, and though injections have slowed down over the past 2 or 3 weeks, storage levels are still very close to a record high for this time. The storage refill gap has been reduced by about 6% versus last year. So even though we have stopped injecting because we really don't need to at the moment, there's still very good visibility to refill the EU storage caverns up to 100% by August, which is more than 2 months earlier than the policymakers' target. So I think that gives you the picture. We've already gone and done our forecast for the storage levels for the exit of next winter. So winter 2025, we see storage levels also above the history or above the norm at about 47% full. So let's say geopolitical surprises aside, the outlook for gas here in Europe is very much for loosening balances. I would say that if there is no geopolitical risks materializing over the next 4 or 5 months, like during the shoulder season, like Vince was mentioning, yeah, there's very low probability for these prices to even hold. We are at about $9 per MBTU or 28 euros per megawatt. We think the floor is more like 20 euros a megawatt if we don't see any more sort of geopolitical tensions rise up or threaten the LNG trade.
Just a quick follow-up. Following Russia's invasion of Ukraine, the European policy makers were very determined to completely cut off European use of Russian gas. How close are they to that goal? Does that 20% drop in demand, get you close to that? And what do you make of that objective? Is it still even a priority?
So it is. I would say it's been achieved on paper, but at the detriment of European industry. So you can call it a success because we've weaned ourselves off Russian gas materially, but we've reduced reliance by about 80% on their supplies. But also this means that our gas prices are sort of structurally higher, like you mentioned at the beginning of our conversation. So that's what's hurting German industry and European industry in general. So yes and no would be the answer. Like the Repower EU plan is sort of on track, but I think it hasn't resolved some other issues, especially in industrial demand. And in terms of the gas flows that we're still receiving from Russia, um, there is there's a very, I think, real risk of or at least half of those residual flows to be halted by the end of this year, because there's a transit agreement that goes through that Russian gas flows through Ukraine. That transit agreement is coming to an end by the end of this year, and Ukrainian politicians have been very outspoken in saying they will not renew this transit agreement. So that means that the supply base for the EU will be like 3% smaller in 2025. But that said, there's another sort of something that the region doesn't speak too much about, is that we still receive about 20 BCM of Russian LNG. And there has been talks of potentially sanctioning those. But I don't think EU politicians will be in a hurry to do that, because that could increase pressure on balances significantly, because that's 20 BCM. You're talking about 6 to 7% of supply on top of those other maybe 15 BCM of pipeline flows. Like, things add up. That, like, you would make things uncomfortable on the price point, at least for EU imports. So I don't think there's appetite for that immediately, but the flows via Ukraine, I think there's a very high probability that those will cease in 2025.
I'm struggling for the right word, perhaps irony or ironic, that Russian LNG is okay versus Russian pipe gas not okay. I think once you add LNG into the mix, you're talking about a much higher cost basis as well. But Scott, let's come back over to you with all this discussion about industrial activity. And I'm curious, it's particularly when you think about your drillers, with the gas price where it's at, is there much interest in drilling specifically for gas? Are they all chasing oil molecules right now? And what do you make of the general landscape in the U.S.? Where's shale drilling going when you look out through the remainder of the year?
Yeah. So the expectation, I think, is for weaker trends than what we expected at the start of the year. I think flat is about right in terms of expectations for upstream spending on U.S. land drilling. You have two negatives really that have emerged this year versus where we were thinking at the start of the year. One is the extreme weakness in gas. Certainly has surpassed our expectations. Now, gas rigs account for maybe 20% of the total U.S. rig count, give or take. Oil is the much bigger factor in terms of U.S. land drilling in general, but certainly the outlook there has been weaker than what was anticipated, and gas basins like the Haynesville and to a lesser extent the ones in the Northeast, the Marcellus and Utica have seen declines in rig count. We're sitting at about 619 rigs active in the U.S. right now. We were at a shade over that at the start of the year, so we're down a little bit, and we're currently looking for 650 at the end of the year. I think there's probably downside risk to that. The other driver of that downside is the consolidation that we've seen in the customer base. A lot of Vince's names. We've seen a continuation of that trend with additional mergers pending closure, and that is another downside driver year to expectations for the rig count in the U.S. Now, that said, we did get earnings out of H&P and Nabors last week. H&P is the largest in the U.S. and Nabors is the third largest. And the guidance for the upcoming quarter, calendar second quarter, is for additional rig releases, not in a huge way, but down certainly from the March quarter. The guidance from the fourth quarter earnings call was that we would probably be flat to up in the second quarter. So that guidance is downside versus prior expectations for the reasons I just mentioned. And so I think that we're probably looking at about a flat year, give or take, on the U.S. rig count The good news, I would say, is that the pricing is holding steady, generally speaking. Leading edge day rates are at about $35,000 per rig. We've seen relative stability within the competitive landscape and increased demand for complementary drilling services like directional drilling, measure while drilling, and increased service intensities bode well for the land drillers generally. But I think we're looking at a flat environment for U.S. land drilling this year. And the last thing I'd say before handing it back is I think investors were encouraged by that. The investor response to that news, I think, was generally more favorable coming off a year like last year, which was so poor for the land drillers. That flat, earnings with a stable competitive backdrop would be perceived favorably by the investment community, as opposed to offshore drilling, as I mentioned earlier, where the expectations were higher coming off a year like last year. So that's, I think, a good summation of where we are. We'll see if the second quarter proves to be disappointing or not.
A quick follow-up, just in terms of translating the flat spend outlook to how you might want to think about it on the production side. If you have flat spending, are we going to see greater efficiencies this year? And so production maybe actually rises, or where does production land? How do you translate that?
Yeah. So last year, that's a good point. So last year, production was up over 10% in the U.S., despite a 20% drop in the rig count. I don't think we get anything like that in terms of efficiencies this year, but I do think we could see production growth on a flat rig count. Yes, maybe it's 5%. Vince might have something additional to offer on that subject, but clearly we're seeing longer laterals. The efficiencies are not just on the drilling side, but also on the fracking side. With the increased stages, all of the metrics that you're used to seeing that determine productivity are still moving higher. And so I think that indeed we could see production growth in a flat rig environment coming off what we saw last year. And the metrics say that that is continuing, but it's continuing at a slower pace. So the second derivative is maybe declining a little bit here. But I think yes is the answer to your question, Rob, but maybe to a lesser extent than what we saw in 23.
Vince, let's hear your thoughts on this.
So I think what we are seeing is companies decreasing spending, but also looking to rebuild, looking to the backlog of uncompleted wells or deferring bringing production on. So in the case of Chesapeake, for example, significant producer in both the Marcellus and the Haynesville, producing combined, well over 3.1 BCF a day. They are looking to rebuild that backlog, hoping for better prices coming into 2025. And by the end of this year, they're going to have roughly a BCF a day of deferred capacity that could come back if prices improve in 2025. So while we're here in the month of starting May, but when we closed April flat at below 100 BCF, similar to last April, and that trend is actually helping the market balance some. While that's off roughly 2 BCF a day from the winter average, a lot of these companies aren't exactly making this production disappear. It's just being deferred to when prices improve. So you still have a great degree of productive capacity that can come on once prices improve. At below $2, that's well below break even, and even in some of the better plays in the U.S. So you're going to need to see prices in that $3 range to get that growth back. But when it does come back, it's going to come back pretty effectively, just given the deferrals and the backlog of uncompleted wells that can come online in 2025 if the market does improve.
Vince, I wanted to ask you a follow-up that I was thinking about while Patricio was chatting about European gas. And I think when you think about Chevron and Exxon, the gas weighting in their production mix, I believe it's been sort of generally going up in time, and this has been part of their energy transition story and that sort of thing. So how would you frame gas within the overall business of the U.S. oil majors at the current moment?
Right. So it's not just about the oil majors. It's also about consolidation among the independents. And you have productive capacity in stronger hands. If you take a look at Chesapeake and Southwestern, they've agreed to merge. They will jump EQT as the largest independent natural gas producer in the U.S. Between those two, you roughly will have, and even including EQT in the mix as well, you have roughly 7-8 BCF a day in the hands of two very large operators. Add Chevron and Exxon to the mix, so you almost have, I don't want to say an oligopoly, but you have greater than elevated exposure to natural gas among these players. So you're going to have a more rational market, I believe. You're going to have probably a little less volatility than in the past because you have that productive capacity in stronger hands.
Okay, I love the idea. Let's keep an eye on that. I think we've reached the end of our time, but just a quick bit of advertising. So next week on this call, we're going to have a guest speaker, Elizabeth Alfano. She is the CEO of a company called VegTech Invest, which is a company that helps run an ETF that's focused on, I guess, a vegan ETF, vegan and climate-focused ETF. And there actually are some intersections with the energy world and that world. And I met Elizabeth at our Farm, Food, and Fuels Summit back in Kansas City last month, and I think it would be fun to hear some of her perspective on the intersection of energy and agriculture. The second thing that I would highlight the following week, so not next week, but the one after, our colleague Salih Ilmaz is going to be at the Qatar Economic Forum. There's going to be a lot of discussion about energy there, and he's going to be joining us live and kind of distilling some of the conversation that'll be taking place there. So we've got two good upcoming calls. Make sure you join for those. And if you have any follow-up questions, we're all green dots on the terminal right now. So shoot us an IB or an email if you want to follow up on anything that we've discussed here today. And I hope everyone has a great rest of their week. Take care.